What is going on, guys? Today's video topic is inspired by Charles Cruz on X. Sorry if I butcher your name. Hey Saverio, I don't think enough plebs get just how important the DCA strategy is for building a portfolio. Can you do a vid on it with your vibes? For example, I use an increasing DCA when below the power law and Mayer multiple falls below 1, 25% when above. This is actually a great video topic and I wanted to expand on the idea. Let's explore the different strategies you can use as a Bitcoiner. First off, we have DCAing, which is typically combined with hodling. This is the slow and steady approach. You invest a fixed amount in Bitcoin regularly, say $100 a month, rain or shine, bull or bear. Over time, you build a stash you hold for the long haul. Think of it like planting a tree and waiting for it to grow. Next, we have investing. In my opinion, the best approach for this is one buy and sell per market cycle. This is the strategist's game. As we know, Bitcoin tends to move in 4-year cycles, at least so far. You buy low during the bear market, sell high during the bull run, and repeat every 4 years. It's like catching a wave and riding it to shore, and you're hoping to avoid the bear markets to compound your existing performance. Finally, trading. This is the high-stakes poker table of Bitcoin. Why am I comparing it to poker? Because 90% of traders are just gamblers who don't know what they're doing. This is due to the Dunning-Kruger curve, where people with limited experience have too much confidence for their own good. You're buying and selling frequently, chasing profits, and trying to outperform Bitcoin's own performance. Because otherwise, you're just better off doing nothing. However, let's split trading into two subcategories because besides manual trading, there is also algorithmic trading, which is a completely different beast. Let's start with the DCA strategy. It's literally set it and forget it. You pick an amount, say $100 a month, and buy Bitcoin on a schedule. Weekly, monthly, you choose. Platforms like BitNob or Cryptomat let you automate this with recurring buys. There's no need to watch charts or predict the market. Tools like the Bitcoin DCA calculator can show you how your investment would have performed historically. For example, $10 a week from 2015 to now would have turned 4,700 into 200,000. And Bitcoin's long-term trend has been upwards, with an average annual return of about 100% since 2011. However, we also know that the average return is not very useful because Bitcoin's returns are diminishing thanks to the power law. So right now, we're talking about something more like 40% a year. DCA in general smooths out volatility by buying at both highs and lows, lowering your average costs. The catch here is that you need diamond hands to hodl through the crashes. You literally need to be able to tolerate 80% reductions in your portfolio value with this strategy. If you panic sell, you're toast. We know thanks to the power law that any capital you put in now will most likely return around 64x in the next 15 years or so, which is pretty easy to remember. Any further capital would have diminishing returns, which means that if you already have more initial capital to put in right now, it might be a better idea to do that sooner instead of waiting to spread it out, unless you're buying near the top of the cycle. Now let's talk about some more advanced type of dollar cost averaging called weighted DCAing, which means that you buy less near the top and more near the bottom. This allows you to reduce your average entry price even further, giving you a better return on investment while throwing less money into the fire near the tops. This is what Charles was probably talking about, and funnily enough, I use a very similar strategy for my own HODL portfolio segment. And there are different ways of doing this with the help of the power law. For example, you could use different colors with the detrended oscillator, the different ribbons with the power law fitting, or even something as simple as using only the 4 25% trend deviation lines in the log-log graph. This is what I'm currently doing to determine how much I put into this portfolio segment every month, at least until Bitcoin's volatility becomes so low that it stops hitting these upper bands over here. Then I will have to adjust. For example, your entry could be at $25 up here, 50 here, 75 here, and 100 down here. And the caveat here is that the money you're saving by buying less near the tops should be used for something productive, such as saving up for being able to buy more when Bitcoin goes back lower, or putting that money into a more liquid portfolio segment that allows you to sell near the top, which is what I am doing. If you're not doing this and spend extra money on booze instead, then this strategy is not as effective as you might think, because you're just reducing the amount of money you're investing in Bitcoin in general. So, in conclusion, whether we're talking about normal or weighted DCAing, this is a good strategy for people earning periodic disposable income every month or week, etc. For example, in addition to the monthly DCAs I do for my own portfolio hodl segment, I purchase some Bitcoin at market value for my son's portfolio every birthday and Christmas also, instead of giving him toys, because who needs toys anyway? I'm messing with you guys. It has always been a bonus on top of the toys, and I'm sure he will appreciate it when he's like 18 in 14 years. But he will only get access to it once he's old enough to learn about responsible investing. Next up, we've got investing, which I'm classifying as one buy and sell per market cycle. So with this strategy, you need to have a good understanding of Bitcoin cycles. This approach would have a much higher chance of disaster if you were just winging it and trying to guess the tops and bottoms. Even when using our full power law model, it is highly advised to account for some deliberate inefficiency. You don't want to be in a situation where you're waiting for a specific number like 200K or 220K and then Bitcoin goes a few thousand below it instead, trapping you into a state of panic and inaction. What I do is that I ladder out slightly below where I think the top will be and back in when I think we're getting close to the bottom. Even with this inefficiency, you can massively outperform buying and holding, especially over the course of multiple market cycles. Let's say you have a quarter of a Bitcoin and want to play it very conservatively, selling before the top and buying back before we reach the power law bottom support, for example. This could look something like selling at 170K and buying back at 85K. This is still a 50% move that you can capture, even if the total down move is like 80%. Over just 2 market cycles, you can simply turn your quarter of a Bitcoin into a whole Bitcoin without any risky leverage trading. Even when capturing a smaller average percentage of the total moves in the next 15 years, you can still make between 6 and 16x with efficiencies of 20 and 50% respectively. Check out our strategy guide by clicking on the link in the description to see different return on investment potentials. My confidence in the good risk to reward ratio of this strategy means that it is used for the largest segment of my own portfolio. It provides a good middle ground between, say, overthinking it by making irrational, hasty decisions and not taking any action at all. It's a very good balance. Finally, we have trading. Honestly, guys, this is not for the vast majority of people, and you don't need it to be successful. If you decide to go down this path, you will be analyzing charts, reading news, and making split-second decisions. It's essentially a full-time job. The Financial Markets Authority found that something like 90% of retail traders lose money due to emotional decisions and market complexity. And don't make the mistake of assuming you're part of the 10% unless you have hard data to back it up. You can produce this data by either demo trading or trading with something like $10. You might not believe it, but you get a similar emotional thrill and investment, no matter whether you're trading with a small or large amount. But only one of those options will likely end up blowing up your account. What you want is a series of trades before you can analyze your win to loss ratio, average profit per trade, and maximum drawdowns. Unless you're a pro, you might not like the results you will see because you're up against institutional traders and bots like Minotaur. So, from my own personal experience, it takes years to learn how to trade properly, and even then, the only strategy that works in the long term is to essentially become a robot yourself. You need to follow preset rules, such as putting in stop losses and take profits beforehand, according to your desired risk to reward ratio. 2 to 1 or 3 to 1 is a good place to start from. Also, you need to have a small enough risk per trade compared to your trading portfolio that you can have, let's say, at least 10 losing trades in a row without doing major damage to your account. We're talking about single digit percentage entries here. Any deviation from this path due to emotions will likely shift the math against you. Because I don't have time to do this on a daily basis, I prefer to take less common and higher confidence swing trades instead, such as longing large bull market corrections or shorting bear market relief rallies. However, if you still want to trade, you can skip the lengthy learning experience and ongoing time investment by trading algorithmically instead. There are all kinds of algorithms out there, from simple grid bots to fancy bots used by institutional traders. You can imagine that the main challenge here for most people is finding the correct one for their needs. There are a lot of bad ones out there that only trade well under specific market circumstances, for example. Bots that trade frequently can also suffer a lot from trading fees, which compounds the problem of certain bots working well only in specific circumstances. Giovanni and I have experimented with a lot of different bots over the years, and the one we can recommend based on extensive testing is the Minotaur trading system. It is very versatile and works well in different market conditions. Trades relatively infrequently as well, even with the 5-minute version, and most importantly uses the power law as a part of its risk management system. This is what my Bybit account's win to loss ratio looks like after 1 month of experimenting with the 5-minute version, which is very difficult to replicate even for a professional trader. In fact, the only losses were from manually closing some trades to experiment with different settings, and one instance where TradingView's alert system went down, which caused a delay in the signal during a moment when the price wicked down heavily, which is an extremely rare anomaly and an example of certain small risks associated with algorithmic trading. Even then, because the bot manages risk appropriately and makes very small trades, things like these were just blips on an otherwise steady staircase higher. There are different versions of the algo, but even with the base settings, you can expect around 40% profits per year, on top of Bitcoin's own market cycle gains with a strategy like this. That's the great thing about using a strategy like this. If you use Bitcoin as collateral for bull periods and stable coins for bear markets, you're essentially creating an investment portfolio segment on steroids. So in conclusion, which strategy is best? None of them. Each strategy has its own benefits. This is why I use each and every one of them. I use weighted DCAing for my HODL portfolio segment for its reliable and consistent long-term gains. You can view this as the lowest risk portfolio segment in the long term, at least in terms of maintaining your existing Bitcoin. Standard deviation can be pretty brutal with 80% crashes, however. Next, I use a conservative investing strategy of one buy and sell per cycle, which gives me the necessary flexibility to multiply my Bitcoin while keeping risk as low as possible by not jumping into less convincing shorter term trades. Then I have two trading segments for providing the largest possible gains but at increased risk. The segment for manual trading gives me the most flexibility to take advantage of highly convincing setups, while the algorithmic one works almost like a Bitcoin miner by creating small, consistent profits on top of Bitcoin's own growth. Together, I have a microcosm of various possible investment strategies, where each segment is competing against each other. Think of it as a Darwinian struggle for dominance, where every segment is doing its best to help grow the overall system. I hope this guide has helped you guys navigate through all the different strategies you can use with Bitcoin so you can find the ones that work best for you. If you enjoyed this guides, make sure to subscribe to this personal channel of mine for more bonus videos, such as guides, market updates, news, and other educational content. This is Saverio speaking, and as always, thanks for watching.